Right now, Tilray Brands, ticker TLRY, is trading at $1.75, a staggering drop of 16.67% on the day. The stock is getting absolutely hammered, and while the immediate reaction for many is to see this as just another brutal day in the perpetually struggling cannabis sector, the real story behind today's catastrophic drop is far more complex. This isn't just about weed stocks anymore. This is about a high-stakes diversification strategy that appears to be backfiring, and the market is showing absolutely no mercy. The expectation has always been that Tilray, by branching out into craft beer and spirits, was building a stable foundation to weather the storm until federal legalization in the U.S. arrived. The reality hitting the tape today is that this foundation might be built on shaky ground itself, exposing the company to a whole new set of economic pressures that investors clearly did not adequately price in. The safety net has suddenly developed some very large holes. If you pull up a chart on your Fidelity mobile app or Robinhood account, you'll see a waterfall decline that started right from the opening bell. The stock gapped down from its previous close of $2.10 and has shown no signs of finding a floor. The volume today is immense, suggesting this isn't just nervous retail traders hitting the sell button. This has the fingerprints of institutional capitulation all over it. Large funds that may have held a position based on the long-term thesis are now heading for the exits. When you see a high-volume, persistent downward trend like this, with no meaningful bounces, it tells you that the sellers are in complete control. Buyers are either gone or are waiting for a much, much lower price. This is the kind of price action that shakes even seasoned investors. While someone holding Nvidia stock has grown accustomed to sharp movements, those are typically driven by major industry news or macroeconomic data. This move in Tilray feels different. It feels specific and punitive, as if the market has fundamentally reevaluated the company's prospects in the span of a few hours. The general belief, the story Tilray's management has been selling for the past couple of years, is one of strategic foresight. The idea was simple: acquire established, cash-flow-positive brands in the alcohol space, like Sweetwater Brewing and Montauk Brewing, to generate revenue and build a distribution network that could be flipped to handle cannabis products the moment federal law allows. It was pitched as a brilliant workaround, a way to build a Trojan horse inside the U.S. market. For a while, the market bought into it, but today's price action is a brutal rejection of that narrative. The deeper analysis shows that the craft beer industry is facing its own significant headwinds. Consumer tastes are shifting, competition is fierce, and input costs are rising. Tilray didn't just buy assets, it also bought problems. And now, instead of the alcohol division providing a stable financial cushion for the volatile cannabis operations, it looks like both segments could be struggling simultaneously. This dual-front battle is a nightmare scenario for a company that is still not consistently profitable and carries a substantial debt load. Investors using more sophisticated platforms like interactive brokers have likely been tracking the declining sales data in the craft beer market for months and are now capitalizing on this weakness. This isn't happening in a vacuum. The broader market sentiment is turning hostile towards speculative, high-debt, no-profit companies. We're seeing a flight to quality. Investors are favoring companies with solid balance sheets and predictable earnings, like Apple stock, over stories of potential future growth. In this environment, a company like Tilray gets punished severely for any sign of weakness. The latest earnings report, or perhaps a guidance update or analyst downgrade, was likely the catalyst for today's sell-off. The market is forward-looking, and what it sees right now is a Canadian cannabis operation that is barely treading water, a European medical cannabis market that is growing slower than hoped, and a U.S. beverage strategy that is now a significant question mark. When you manage your individual brokerage account, you have to separate the story from the numbers. The story was compelling, but the numbers today are painting a very different picture. The expectation was diversification equals safety. The reality is that diversifying into another challenge sector just multiplies the risk. So what exactly is Tilray Brands? At its core, it's a Canadian cannabis producer that has grown through aggressive acquisitions, most notably its reverse merger with Aphria. It operates globally with a significant presence in Canada's recreational market, Germany's medical market, and other international jurisdictions. Its business is split into a few key areas: cannabis, which includes dried flower, oils, and edibles; distribution through its subsidiary CC Parma in Germany; wellness products through its Manitoba Harvest brand, which sells hemp-based foods; and the aforementioned beverage alcohol segment in the U.S. The goal has been to become a global consumer packaged goods powerhouse with cannabis at its heart. The problem is that each of these segments has its own unique set of challenges. The Canadian cannabis market is plagued by oversupply, intense competition, and high taxes, which keeps prices and margins painfully low. The European expansion is promising, but subject to a complex web of regulations that vary by country, slowing down growth. And as we've discussed, the U.S. beverage play is now under a microscope. This multi-pronged approach, which was supposed to be a source of strength, now means the company is fighting battles on multiple fronts, stretching resources and management focus thin. Looking back at past performance, this isn't the first time Tilray has disappointed investors. The stock has been in a brutal, long-term downtrend since the cannabis bubble burst years ago. There have been brief, violent rallies, often fueled by news about potential U.S. legislative reform like the Safe Banking Act, but none have been sustainable. Each time the rally fades as the legislative reality sets in and the company's fundamental performance fails to justify the higher valuation. For those using SoFi Invest or other platforms catering to a new generation of investors, Tilray has been a lesson in the dangers of investing in a sector that is heavily dependent on political whims. The company has consistently reported net losses, and while revenue has grown through acquisitions, organic growth has often been lackluster. Furthermore, to fund its operations and acquisitions, the company has repeatedly issued new shares, leading to significant shareholder dilution. This means that even if the company's value grows, each individual share becomes less and less valuable. This is a critical factor that many retail investors using a simple Robinhood stock trading interface might overlook when they just see a low share price and dream of it returning to its former highs. Looking ahead, the path for Tilray is fraught with both immense risk and potential catalysts. The bull case, the dream that keeps long-term holders invested, still hinges almost entirely on the United States. The recent move by the DEA to consider rescheduling cannabis from Schedule 1 to Schedule 3 is a significant step forward. This wouldn't make it federally legal for recreational use, but it would ease research restrictions and potentially provide tax relief for cannabis companies operating in legal states, which could be a huge benefit for Tilray's future U.S. ambitions. If the Safe Banking Act or something similar were to pass, it would allow financial institutions to work with cannabis companies, opening up access to capital and reducing the cost of doing business. These are the major events that could cause the stock to multiply from these levels. A successful turnaround in their beverage alcohol division, perhaps by focusing on their strongest brands and cutting costs, could restore some investor confidence. With the beverage strategy hitting some bumps, do you think Tilray should double down on cannabis or continue diversifying? Comment your thoughts below. However, the bear case is powerful and present. The biggest risk is the balance sheet. Tilray has a significant amount of debt, and its ongoing cash burn means it may need to raise more capital, likely through more dilutive share offerings, especially if interest rates remain elevated. Continued weakness in the Canadian market, combined with a stalled beverage strategy, could lead to a downward spiral. There's also the persistent threat from the illicit market, which continues to capture a large share of cannabis sales due to its lower prices. For an investor considering building a position, this is not a stock you can simply buy and forget about in a Schwab Intelligent Portfolios type of setup. This is an active, high-risk investment that requires constant monitoring of legislative news, sector trends, and the company's quarterly financial results. You have to question if the potential reward justifies the very real risk of further downside. Many professional traders on Interactive Brokers are likely betting that it doesn't, maintaining short positions against the stock. Even the more accessible SoFi trading platform provides tools that show the immense short interest in names like Tilray, highlighting the deep skepticism within the market. This is a battleground stock in every sense of the word. In conclusion, the brutal 16% decline in Tilray stock today is a stark reminder of the gap between a compelling narrative and a difficult operational reality. The market's expectation was that Tilray was building a diversified, resilient consumer goods company using alcohol as a profitable bridge to an eventual U.S. cannabis jackpot. The reality crashing down on investors today is that this bridge is looking unstable. The company is now grappling with simultaneous challenges in both its core cannabis business and its key diversification play, all while burdened by a heavy debt load in a market that has lost its appetite for speculative growth. The dream of U.S. legalization remains the ultimate prize, but the path to get there is proving to be far more perilous and costly than many had hoped for. Today's sell-off isn't just a dip, it's a fundamental crisis of confidence in the company's entire strategy.